Welcome to the FinTalk series. So, you're thinking about investing, right? Whether it's a cool new startup or a company that's been around forever, you're immediately faced with a huge choice. And this choice, well, it defines everything: your risk, your potential reward, and your whole relationship with that business. Today, we're going to break down the two pillars of finance: equity versus debt.
All right, picture this. You've got some money saved up and you're ready to make it work for you. But the second you decide to invest, you're kind of standing at a fork in the road. And believe it or not, your whole decision really boils down to one simple question. Do you want to be an owner or do you want to be a lender?
These are your two main paths. On one side, you can become an owner. You're buying a piece of the action, you get a say, and you share in the wins and the losses. On the other side, you can be a lender. You're like the bank. You provide the cash, but you stay out of the day-to-day business. So let's dive into what it really means to be an owner first.
And that brings us right into the world of equity. And you know, that idea of buying a slice of the company pie, it's not just a cute saying. You are literally becoming a part owner of the whole shebang, from the logo to the laptops.
Now, the official kind of fancy name for your slice of that pie is an equity instrument. Just think of it as your official ownership certificate. It's the piece of paper that proves you have a real legal claim on the company's assets and a right to its future profits. But here's the thing. Not all ownership stakes are the same. The most common type is equity shares. These are the ones that usually give you voting rights, so you actually get a say in how the company is run. Then you've got preference shares. With these, you usually trade your voting rights for being first in line to get paid dividends. And last, there are deferred shares, which are often for the founders and give them special priority.
So what's the big payoff for an equity investor? Well, the reward is really a two-parter. First, if the company does well, the value of your shares can go up. That's what we call capital appreciation. And second, the company might just share its profits directly with you through regular payments called dividends. Pretty cool, right?
Okay, so that's the owner's path. But what if that sounds a little too much like a roller coaster? What if you'd rather have a solid promise than a maybe? Well, that brings us to the other side of the coin: debt.
Unlike equity, a debt instrument has absolutely nothing to do with ownership. It's basically a formal IOU. You're lending money to a company, and they promise to pay you back your original loan, that's the principal, plus regular interest payments. In a way, you get to be the bank.
Now, in the world of debt, you'll hear two main words: bonds and debentures. A bond is a loan that's secured by collateral. That means if the company can't pay you back, you have a claim on its actual stuff, its assets, which makes it safer. A debenture, on the other hand, is unsecured. It's only backed by the company's reputation and its creditworthiness, so it's a bit riskier, but because of that, it usually pays a higher interest rate.
And the reward for being the lender? It's all about predictability. You get a fixed return. It doesn't matter if the company has a terrible quarter or a fantastic, record-breaking year. Your interest payment shows up right on schedule. It's a stable, predictable stream of income.
All right, we've met the two contenders. Now it's time for the main event. Let's put equity and debt right next to each other in a head-to-head showdown. This is where you can really see the differences shine.
Let's just break this all down. At the heart of it, equity is ownership and debt is a loan. And that one single difference causes this huge domino effect. As an owner, you're taking on more risk, but your potential for reward is basically unlimited. As a lender, your risk is much lower, but your return is capped at whatever that interest rate is. It's also why equity investors get a vote. Hey, it's their company, while lenders don't. And think about time, too. An equity stake could last forever, but a debt always has a finish line, a maturity date when the loan gets paid back in full.
So when you strip it all away, it really boils down to this one essential trade-off. Equity offers you that thrilling shot at huge returns. It's the potential rocket ship, but it comes with some serious risk. Debt, on the other hand, offers safety. It's a predictable income stream with lower risk, but there's a ceiling on how much you can make. It's growth versus stability. That is the core choice.
Now, knowing all this is great, but what really matters is how you use it. So, how do you actually choose a strategy that's right for you? Well, it all starts by asking yourself, what kind of investor do I want to be?
And listen, this isn't a trick question. There is no single right answer that works for everybody. The absolute best path for you depends completely on your own situation, your goals, and frankly, how you feel about risk. Here's a super simple two-step way to think about it. First, you have to be honest with yourself about your risk tolerance. I mean, really honest. If your investment dropped 20%, would you be up all night worrying, or would you see it as a chance to buy more? Second, what are your financial goals? Are you playing the long game, saving for something 30 years from now where growth is key? Or do you need this investment to generate some steady income for next month's bills?
Understanding this difference between equity and debt isn't just a fun fact. It is the absolute foundation for building a smart, effective portfolio. Getting this part right is your first and maybe most important step.
So if you only take one thing away from our chat today, please let it be this. Understanding that fundamental difference between being an owner and being a lender is the absolute key. It is what will guide every single investment decision you make from here on out.
So I'll leave you with a question to think about. Now that you know the two fundamental paths, the path of the owner and the path of the lender, which one are you curious to explore first? Thank you for listening to this FinTalk episode.